Have you ever pondered the fairness of international credit rating institutions? If you haven't, it's high time we did. Credit ratings, in essence, are grades given to countries based on their economic health. These grades are crucial as they can influence the interest rates that countries pay to borrow money. The higher the rating, the lower the interest rate, and vice versa. Now, these ratings are not determined in a vacuum. They are given by certain institutions known as credit rating agencies, such as Standard & Poor's, Moody's, and Fitch. This system may seem straightforward, but it's more complex than it appears. Let's take a closer look. In essence, credit rating agencies evaluate a country's ability to repay its debts. They consider a multitude of factors, from economic indicators like GDP growth and inflation rates to political stability. Based on these factors, they assign a rating. But here's the catch. The methodologies used by these agencies have come under scrutiny for being biased against developing countries. The Indian government, for example, recently released a document criticizing the way these agencies determine sovereign ratings. The government argues that the methodologies disadvantage developing countries. It points out that these agencies often ignore the role of public sector banks in promoting financial inclusion, a significant factor in economic stability. Furthermore, the government highlights issues with the selection of experts involved in the rating process. It questions the lack of transparency in conveying the weights assigned to each parameter. A particular point of contention is the influence of subjective appraisals and the composite governance indicator on sovereign ratings. The government's calculations suggest that these factors have a significant impact on the final rating more than what may be justified. These criticisms are not just academic debates, they have real-world implications. A lower credit rating means developing countries have to pay higher interest rates to borrow money. This can hamper their economic growth and development. Moreover, the bias in credit ratings can perpetuate inequality between developed and developing nations. It can discourage investments in developing countries, further widening the economic gap. So, what does this all mean? It means that the current system of international credit ratings needs a re-look. It needs to be more transparent, more inclusive, and less biased. As we wrap up this conversation, remember this. Credit ratings are more than just grades. They are indicators of a country's economic health and future prospects. They can make or break economies, and it's high time we ensured that they are fair and unbiased. Thank you for tuning in. Until next time, stay curious, stay informed.